Peter Mcguire is also joining us today and live from our Sydney studio. Peter, good to have you with us. Countdown to Brexit, Peter, and we've been, talking to you about some of the implications of that. But as we get nearer to the big event, what's your sense? What's the mood right now? Do you feel markets are well prepared and ready for it?
Well, good morning. Thanks for inviting me on the show. Yeah, we've seen a nice uptick as far as Asian trading today. Japan up, going across the whole board is showing a sea of green. So I think it was sold off fairly heavily this week. We've seen that little price rebound, and it was probably just exhausted to the downside. There was certainly concern, and it's an ongoing concern, naturally, with the assassination of the British MP up at Yorkshire. So, it shows some, very sad event completely. And that's impacting, I think, some reality to the market. Also, you've seen what's happened today as far as, better than expected growth coming out of Japan on their bourse. They've had a very nice uptick of around about 1.3, 1.4%. So at the present, I think it's a green light for equities, possibly even over the next couple of days.
Peter, I wanted to start out first with the kind of situation we have in the debt markets, which is, I read some staggering data that we have the lowest interest rates in 5,000 years. Even the pharaohs of Egypt did not pay this kind of interest. Neither did Napoleon. Neither did it happen in the Great Depression. If that's the scenario, my question is, are we living on borrowed time? Because, we go back to 1980, U.S. Treasury yields were 15%, and cycles always happen. When this cycle reverses, Peter, what happens to the stock markets? What happens to emerging markets? What happens to commodities?
Well, yeah, when you look back, 5,000 years is a hell of a lot of data. I knew that we were at 500-year lows as far as UK and certainly France. And I think Germany as well, and the Netherlands. So, you take on board the seriousness of the issue. I think we're just in a long, slow grind for the next, 5 to 10 years as far as very, very low interest rates. But when it does turn, and I'm not sure when that date will be, I think there's going to be a lot of issues at hand. You're looking at currencies. Are we going to a new normal that it's just a low interest rate environment moving forward for, another generation? It's a hard one to really draw a line on. But what happens, you're going to see confusion in markets, you're going to see large volatility swings. I think you're going to see currency issues. What happens as far as the renminbi, where does the larger currencies go? And over the next 10 to 15 years, we've got changing of the guards in so many ways, from China to the US, of course the Indian economy, and where does Japan play? So, yeah, I think it'll just add volatility and confusion.
Now, Peter, that brings me to another question. Sometimes it looks to me, again, another data is that we have had 650 central bank cuts in interest rates since the Lehman crisis. One of the things it may be doing is that if you look at the population in Japan, the population in Europe, it's an aging population. In fact, if I got up the next morning and I can't even expect any interest rates till the time I live, I mean, obviously I'm going to stop spending because all I have is my principal. Could it be that these central bank moves have actually driven people not to spend? And without spending, no economy revives. I mean, your thoughts on that, Peter, because this seems to be like a very counterintuitive argument that, people just decided not to spend because they can't see themselves retiring with any returns.
Exactly right. I mean, the baby boomers, and have a look at what's happening as far as, the markets. Very little growth over really the last, 6 to 7 years on a lot of those stock markets compared to their all-time highs, excluding the US. That's so true. I mean, it's the same situation in Australia, the baby boomers having to work well into their 60s and 70s with very little pension and no real capital growth. So I think that that's a real issue. It'll only exacerbate, and I think it'll even become harsher as each year rolls on, that people will be working longer and longer into their... I don't think there will be a retirement. And that's just a reality of the fact. I mean, in Japan, you see many people in their 70s working. When I travel to Tokyo, the same sort of thing happens when I see people in the US. You know, it's not unusual now to see people working in their 70s and late 70s as a necessity, not necessarily a want, but a need. And that's the changing of the guard, and that's what low interest rates have done as far as savings and so on. So, yes, it limits spending power, it limits people aren't prepared to buy, and that seems to be a common occurrence in the West.
Peter, there was a report by Goldman Sachs sometimes in the 60s, you know, if I read it correctly, and at that time, Goldman Sachs thought that Burma, which is currently called Myanmar, and Philippines were going to be the superpowers of Asia. Of course, none of that happened. Then, of course, everybody loved Malaysia, Thailand, Indonesia. Of course, they just blew up. Now, of course, they love China for some time, but that's somewhere near blue. And we're, of course, the next ones. What concerns me is that every time liquidity dries up in the markets, the first place the money moves out of are the very countries people say are simply indestructible. What's your view, Peter? Is something different this time? Because without liquidity flows all this beauty, all this great growth. You can't grow in isolation. We still live in this world. Will the money move out of emerging markets should the situation continue?
Well, if the situation becomes harsher as each year rolls on, then that could certainly be a dilemma, you know, 2020. But at the present time, money's flooding in, the infrastructure spend, and of course, just it's gaining momentum all across Southeast Asia, from India all the way across, of course, to the likes of Thailand, as you mentioned, and even the Philippines. I mean, they are a fast-growing economy, Vietnam and Cambodia. But when we take on board, if there's limited spending in the Western world, we need new spenders to enter marketplaces, and the likes will be the Chinas and, of course, the Indian population and the Gulf states. I think that it's going to be just a little bit of a reality check and maybe a changing of perceptions. But people are living longer. They do require goods and services all over their lifespan. And with a growing population, I think that that's going to satisfy a lot of these markets. Your population growth is just so immense over the next, 25, 30 years. We're going from 7.3 or 7.5 billion to about 9.2 billion. So those extra nearly 1.5 billion people will certainly make up, and then you've got longevity playing into that as well as far as life expectancies. So I think it's going to be green lights ahead.
Right. Peter, I just want to also ask you a question about zero interest rates or even negative interest rates. An average German trusts the Bundesbank or, whichever the government place they give money to just keep their money and not even give them any interest. That's similar to an American who's rather happy to be in a treasury yield, which is a quarter, and Japan, of course, we know what's going on. When they don't even trust the companies and the stocks in their own country, they won't invest in a German stock, they won't invest in an American stock, they won't invest in an Australian stock. Isn't it a tall order asking them to invest in Chinese stocks and Indian stocks and stuff like this in this environment?
Yeah, well, that's a very good question. That's so true. And no, I would say that you're going to have less and less appeal because people are worried about risk. Certainly, what happens, I mean, they'll look into the future and they'll see growth and they'll see opportunity, but they'll also see safety. And I think that, as we've mentioned over the last couple of months, the Brexit issue is one concern. What happens as far as Trump is another, or Clinton, of course, and leading into the next 6 months, we've had large price spikes as far as commodities. The gold market's now at about $1,300, nearly $1,300 an ounce. Crude's doubled in the last matter of, 3 months. So taking all that on board, there's still that high level, I think, of risk, and people are very conscious as far as, growth expectations. And the old saying, it's a return of your money, not necessarily a return on your money. And that's where they're looking at the present time. People are prepared to just put their money in, not get a return, but at least to know that in some fashion or form it is safe.